The topic of the day is depreciation. Now, what does depreciation means? Depreciation is an expense for the business. Depreciation basically means if we buy a car, motor vehicle, and if we keep using it, the car will lose its value due to use and some other factors. The car does not remains brand new for forever. It loses its value. Its shine is not like it was new. As the car is running, the tires do also wear, and the interior also gets old, and there are scratches on the body, and there are maybe some dents on the body, and there is some color shade off. So these are all the things that make the car lose its value, and the reduction in the value of non-current asset is known as depreciation. Now, let me read the definition for you. Depreciation is part of original cost of a fixed asset that is consumed during its period of use by the business. Means the part of the asset that we have used during this year is known as depreciation. If I have bought a car for maybe $100,000, the car is left over for $90,000 after 1 year, for example. So I have used the car worth $10,000, and this is depreciation. So it needs to be charged to profit and loss, that is income statement. Depreciation is an expense, it is charged to income statement. The amount charged in a year to profit and loss is based upon an estimate of how much of overall economic usefulness of a fixed asset has been used up in that accounting period. Means if the asset is the life of the car is 10 years maybe, and if I have used the car for 2 years, so 20% of the asset is depreciated, and we'll be charging this depreciation to income statement. So depreciation is basically an expense, and it is also known as a non-cash expense. Why? Because if we depreciate an asset, every time we depreciate, we make an accounting entry. So this is just basically an accounting entry, and we do not need to pay the amount every year. So whenever we buy a non-current asset, whenever we buy an asset, we are actually paying the money for buying that non-current asset, and if every year we depreciate that asset, every year we do not incur an outflow of money. So depreciation is therefore a non-cash expense. Now secondly, we have causes of depreciation. Causes mean the reasons. What are the reasons behind the depreciation? Means why does a non-current asset depreciates? So there are basically 3 reasons. 2 of them are more common. One is physical deterioration. Now what is physical deterioration? Again, if we stick with the example of motor vehicle, the motor vehicle wears and tears due to usage. Means the interior gets old, the exterior gets old, the paint is not as new as it was before, the tires got used, and the seats got torn off, and these are all wear and tear stuff. Then if we are using the machinery, due to use the machinery, the parts are again damaged due to use. If there is fixture, furniture, it gets old, the polish gets worn off, and these are all wear and tear. Then we have erosion. Again, the value is lost. Erosion, there is rust on the metallic parts, or maybe rot and decay with wood. There is rust on metallic parts, and there is rot and decay in wooden parts. So these are all known as physical factors. After physical deterioration or physical factors, another factor is economic factors. Economic factors is something like if we have bought maybe an iPhone. If we bought 2 iPhones, or for example, we bought iPhones back in 2 years back, and that was iPhone 6 or 6s. We bought 2 iPhone 6, and we used one of them, and we kept second of them box pack, and we did not need it, but we bought it somehow to give someone. But due to some reason we were unable to give it to someone, and the iPhone, we still own that iPhone, and it is box pack. Although it is box pack, it is not used at all, but it reduced its value during the years. Why? Because of economic factors, obsolescence. The iPhone is now out of date because now there are new generations coming, maybe iPhone X or some other latest models of this. So this is known as economic factors. Mostly it happened with medical equipment or musical equipment or other computers or laptops and gadgets, and anything that is related to technology, it becomes obsolete very soon. Then inadequacy, not up to the required use, means the asset that we bought previously was according to our requirements, but during the year our requirements changed, and now we demand something more powerful in terms of its capacity or in terms of its specifications. Maybe the machine or maybe computer, maybe a phone, maybe iPhone 6 was good enough for us when we bought it, but now the software which we want to run does no longer support the iOS that iPhone 6 offers. Then this means that the machine is now inadequate for us. This is known as economic factors. So basically these two factors are tested in examination. The third one is time factor. Time factor is basically applicable on intangible assets. Intangible assets are assets that we cannot touch, such as patents or license or maybe the software, and these are the stuff. So if we have bought a building on a lease, the lease expires due to time, the lease contract it depreciates in value, and this factor is known as time factor. Means we are not doing anything, but just with the passage of time, if you have bought some license or import quota or a franchise, a day after day the license or that maybe the permit reduces value, and this is known as time factor. So these are the three basic factors that cause depreciation. Then we'll be discussing the methods of depreciation. Although there are many methods of depreciation in practice, but in exams, in CIE exams, or three methods are being tested, and it's part of the syllabus. One is straight line method, then we have reducing balance method, and then we have revaluation method. So I will be starting with straight line method. Straight line method, also known as cost method, is basically used for assets such as furniture, fixture and buildings. Now what is common in all these? The common thing in all these is that they all reduce value, same value every year. So any asset whom usage pattern is not easily being identified, or if we know that we are using asset on equal basis, that is we are using the asset evenly, we are not using it sometimes more and sometimes less. The usage, if the usage is not uneven, or if the usage is even every year, equal each year, we'll be using straight line depreciation. Now the specific part or important part of straight line method is that the straight line charges equal depreciation to your non-current asset each year. Now let's discuss the specifics. The formula for the straight line method: formula is cost minus scrap value upon useful life. Cost is the original cost that we have bought the asset in. There are different words that can be used for cost, that is historical cost, original cost, purchase price or list price. All of these terms are used by the examiners. They will be deducting scrap value from the cost. Scrap value is also known as salvage value or residual value. It is the value at which the asset will be sold at the end of its life. If the asset life, we have estimated the life as 5 years, and at the end of the life we can say that if an asset that we have bought for 50,000 can be sold for 5,000 after 5 years, then the 5,000 will be estimated scrap value. Although it is an estimated value, not an actual one, because we cannot be sure at the price that with the asset will be sold after 5 years until and unless we actually sell that asset. So this is an estimated value. Then again, the useful life. Useful life is the estimate of the life according to management, that how many years we can take benefit from this non-current asset. So if there is a life, that will be dividing it with the life, or if there is a rate percentage given in an examination question, will be multiplying. So then the formula becomes cost minus scrap value multiplied by rate. So if there is a life, we will be dividing it, and if there is a rate, we'll be multiplying it. So the answer to this formula will be the straight line depreciation, and the depreciation will remain same for every year according to this method. So same depreciation is charged in straight line method. Then secondly, we have another method, that is reducing balance method. Reducing balance method, also known as diminishing balance method, is normally used for technological assets. Now in most of the exam questions, it basically asks, the examiner basically asks that why is reducing balance more suitable for machinery or motor vehicles than straight line. So we need to answer this. The answer for this question is that all technological assets are obsolete very soon, so there should be a method that is capable of charging more depreciation in early years and low depreciation in future years. So reducing balance is particularly the method that charges high depreciation in early years of a life of an asset and low depreciation in later years. So all technological assets such as machinery, equipment, computers, projectors and multimedia and all these gadgets and motor vehicles are normally depreciated using reducing balance method. So in reducing balance method, the depreciation decreases each year. And why is that so? Because of this formula. The formula is cost minus accumulated depreciation multiplied by rate. In straight line, the formula was cost minus scrap value multiplied by rate, and in reducing balance, the formula is cost minus accumulated depreciation. Now accumulated depreciation is also known as provision for depreciation. Provision for depreciation or accumulated depreciation means the total amount of depreciation that is charged on a non-current asset up till particular date. This is total depreciation charge till date, is known as accumulated depreciation. Now as you are aware, in the first year we do not have any accumulated depreciation, so what we will be doing, will be multiplying rate multiplied by cost multiplied by rate in the first year, and then in second year we'll be deducting first year depreciation from the cost, and then we'll be multiplying rate, and then after 2 years we'll be deducting first 2 years of depreciation from the cost, and then we'll be multiplying rate. As you are aware, the accumulated depreciation keep increasing every year, and if the accumulated depreciation keep increasing, cost minus accumulated depreciation, that is also known as net book value, NBV. The net book value of the asset is decreasing every year, and if the net book value is decreasing, if we multiply by rate, the depreciation also decrease every year. So in reducing balance method, technological assets are normally charged with reducing balance, and one more reason why such assets such as equipment, machinery, motor vehicle are charged using reducing balance method. This is the point, as you can see in this box. In early years, see, there is an example. If we buy a new car, you think about it, if we buy a new car, will we be incurring higher repair and maintenance in early years or low repair and maintenance in early years? Obviously, if the car is new, we do not need much repair and maintenance for that car. Therefore, low repair and maintenance for early years. If there is low repair and maintenance, we'll be charging higher depreciation using reducing balance. Now vice versa for later years. In the future years, as repair and maintenance steadily keep growing, why as the car gets older, it needs mechanic sooner or later, and it needs mechanic and maintenance and oiling more often than used to be previously. If the repair and maintenance keep increasing, therefore we will be charging lower depreciation. So this is somewhat balanced. If there is low repair and maintenance, we'll be charging higher depreciation, and if there is a higher repair and maintenance, we'll be charging lower depreciation. So in reducing balance method, there is high depreciation in early years, initial years, and low depreciation in future years, and vice versa for repair and maintenance. So this was the second point. Now we have the third and the last method, last but not the least, that is the revaluation method. So see, different types of asset require different depreciation method. A revaluation method is normally used for assets such as low cost items such as loose tools. Tools, if you're aware that when you go to a garage to repair for your car or any other asset, so the tools that are being used by the garage or the repair shop are maybe the jack and maybe the screwdrivers and maybe the other stuff. These are known as loose tools. So these are a non-current asset for a business, loose tools. So after loose tools we have some other assets such as laboratory items. Laboratory items are also charged with revaluation method in a laboratory where we go for blood test, or maybe the small items that are used by the chemist or lab assistants. These are laboratory items. And then crockery, if we go to some restaurant for dining or this thing, so the crockery and the plates, as the spoon, the fork, the glasses, the jugs, these are all assets. And maybe the crates, if we see a Pepsi Cola or Coca Cola truck, they are carrying cold drinks in some plastic crates. The plastic crates are also depreciated using revaluation method. So basically assets that are low in value and that do not warrant charging separately depreciation on each asset, then we'll be using revaluation method. So there are basically two ways to depreciate an asset using revaluation method. The first method, that is more common, is that we make a T account. The T account is known as net book value account. In a net book value account, we'll be starting with balance BD. As you are aware, these are all assets, and the nature of the asset is debit. So balance BD will always come on the debit side. If the balance BD is on debit side, then balance CD always comes on the opposite side. This is the opening value of these non-current assets, maybe tools or crockery or crates. These are opening values and these are closing values. And in this revaluation question, if the cost is also given for an asset and the value is also given, we'll be always using value and not the original cost. Value means the amount that can be fetched with the sale of a non-current asset in present condition. This is the value, fair value. Then if we buy a non-current asset, we'll be making an entry loose tools debit and bank credit. And if we are buying an asset on credit terms, we'll be using payable or liability instead of bank. And then when we are selling a non-current asset, we'll be using a disposal account, and asset will be credited and the disposal account will be debited. And this would not be the amount that we have actually received by selling a non-current asset. This will be the value of non-current asset, means the value that should be fetched, or the net book value, the value that remain in our books when the asset was being sold. So this is an important point. We won't be using the amount at which we have sold the asset, but the value that was in our books at the time of disposal. Then balance CD, and the difference that is coming according to this T account is depreciation, will be charged to income statement. Opening plus addition minus disposal minus closing. Now instead of making this T account, there is another shortcut formula, shortcut method, which is again is the same. This is a equation based representation of this formula. Opening value, this means balance BD, plus addition means the new asset that we have bought in this year. Then disposal will be deducting, minus disposal will be deducting the asset that we have sold. Again we'll be using the value and not the amount at which we have actually sold the asset. Then minus closing value, this is balance CD. The difference that comes with this formula, or the final answer that is stated with this formula, is known as depreciation using revaluation method. So revaluation method is basically used where no other depreciation method is mentioned in an examination question. And for straight line, you need the rate of the asset or the life of the asset, and for reducing balance, again you need the method, the percentage, that is the rate of depreciation. But in revaluation method you do not need anything, and if the examination question doesn't state the method and it doesn't gives us the rate or the life of the asset, we always be using revaluation method. So revaluation method is basically used in single entry questions, single entry or not for profit club accounts questions, because club accounts, not for profit accounts are also solved using the single entry concept. Now let's move forward. After discussing all the method for depreciation, we'll be moving for policy for charging depreciation. Now, as we already discussed, there were three methods for depreciation. One was straight line, another one was reducing balance, and the third one was the revaluation method. While there are three methods for depreciation, there are basically two policies for depreciation. One is full year policy and one is time proportion basis. Now what is full year policy means? Let me read these words for you, official words. Charge full year depreciation in the year of purchase but no depreciation in the year of disposal. So basically this policy is normally written in an examination question. In full year policy we do not see when we have actually bought the asset, at which date, and which date we have actually sold the asset. If at the end of the year we own an asset on 31st December, we do not ask that asset that when were bought. We just see if the asset, we have an asset at year end, will be charging full year depreciation no matter that we have bought the asset on 1st January, that we have used it for 12 months, or maybe we have bought it for 1st July, we have used it for 6 months, or maybe we have bought the asset for 1st October, we have used it for 3 months, or maybe we have bought an asset on 1st December and we have only used for 1 month. No matter, whenever we have bought the asset, if the asset remains with us at the end of the year, we'll be charging full depreciation no matter the date at which the asset was bought. Similarly, if we have sold the asset before year end, and if we do not own that asset on 31st December, we won't be charging any depreciation if we are using full year policy. So, and the second policy is month-wise policy. In month-wise policy, we will be charging depreciation in the year of purchase and in the year of sale, and we'll be charging depreciation on month-wise. Month-wise means we'll be charging depreciation for exact number of months that we have used the asset. For example, if we have bought an asset on 1st January and our year end is 31st December and we are using time proportion or pro-rata, it is also known as pro-rata basis, we'll be charging depreciation for whole 12 months from January to December. If we have bought an asset on 1st July, we'll be charging depreciation from July to December, that is 6 months. Will be proportioning it as 6 upon 12. Then if we have bought an asset on 1st October, then we'll be charging depreciation for October, November, December, that is only 3 months, we'll be multiplying it with 3 upon 12. If we have bought an asset on the last month, that is 1st December, we'll be proportioning it by 1 upon 12. So this is time proportion method or pro rata basis. If we have sold an asset in this year, again, if we have if we have sold the asset on 31st March, we'll be only charging 3 months depreciation for January, February, March. If we have sold the asset on 30th April, we'll be charging 4 months depreciation January, February, March, April. So these are two of the policies we can use in exam, and the question here arises, do we have choice as to which policy we need to use in exam? No, you do not have a choice. The examination question sometimes specifically mentions the policy particularly that we need to use in exam, whether it is full year policy or month-wise policy. But if the examiner does not mention the policy that we need to use, then we have to see if the dates of purchase of asset or acquisition of asset or disposal of the asset are given. If the dates are given, the dates at which we have bought an asset or sold an asset, then we'll be always using month-wise policy, that is time proportion. And if the dates are not mentioned in an examination question, we'll be using full year policy, because we cannot use month-wise policy because if the dates are not given. Then the better method is time proportion basis or pro rata basis, because it is more accurate and therefore it is used as an examination question. So in O levels, most of the time, maybe 80% of the times, the examiner asks for full year policy, and sometimes the examiner also asks for time proportion policy, CIE O levels. But in A levels, AS levels, all the time examiner uses month-wise policy. So month-wise policy is most popular in A levels, and full year policy is more popular in O levels because it is somewhat easy. Now let's move towards the mechanics or the accounting for depreciation. First of all, we need to understand the journal entry for depreciation. As you are aware, the depreciation is an expense for the business, will be debiting income statement with the depreciation for the year, and will be crediting with provision for depreciation. Now what is provision for depreciation? Provision for depreciation is a separate account. Provision for depreciation, the nature of provision is credit. Why it is credit? Provision basically means an estimate for depreciation. Provision account is a contra asset account. Now what does the word contra asset means? Anything that reduces the value of your asset is known as contra asset. If you have heard my lecture, if you have listened to my lecture of bad and doubtful debts, you may be aware of the example that I gave there. Let me repeat this example for you. See, the life is an important gift by Allah subhanahu wa ta'ala. The life is a gift by God the Almighty. The life of human being is an asset. The life is an asset, and if someone smokes cigarettes, the life expectancy of that person reduces. The cigarette is a contra asset for life. Similarly, if the machine or motor vehicle is an asset, provision for depreciation reduces the value of that machine. Therefore, provision for depreciation is a contra asset for that machine. So whenever provision increases, it is always credited because it is a contra asset. It is not a liability. We do not need to pay someone that money. This is just a contra asset. It will be credited. So income statement will be debited. And now we need to discuss the T accounts that are required in an examination question. So basically there are 3 to 4 T accounts that we are required to make in exam. First of all, we have an asset account, that is cost account. Whether there is equipment, machine, motor vehicle, building, or any other non-current asset, we are required to make a T account for cost of the asset. The balance BD, as you are aware, the asset is as an asset. Asset is the nature of the asset is debit. So balance BD comes on the debit side. If balance BD is on debit side, balance CD, the closing balance, always comes on opposite side. Whenever we are buying a non-current asset, it is increased that it is debit. So equipment account will be debited with reference to bank if we have paid the money through check, and if we haven't paid the money, then therefore the liability account means the supplier name will be used, maybe Honda Motors. Then if we have bought a non-current asset, we'll be adding it, and if we have sold a non-current asset, we'll be deducting it and transferring it to disposal account. We will be discussing disposal entries very soon. Then opening balance is on debit side. If we add up an asset, we buy non-current asset, we'll be debiting it again, then increasing it. And if we are selling a non-current asset, in disposal, we'll be using original cost, because this account is a cost account. That is, it is not the amount at which the asset is sold, it is the original cost, that is the original price at which we have originally bought the asset. Then balance CD, then these two sides are made equal, so shorter side is balance CD, and the balance CD will becomes balance BD, that is opening balance in the next year. Then comes the provision for depreciation account, which is also known as accumulated depreciation. Accumulated or provision for depreciation is the total depreciation of all non-current assets at that date. So provision account is basically made for each class of an asset. Similarly, that asset account is also made for each class of asset. Means there will be one account for equipment, one another account for machines, one account for motor vehicles, and one account for buildings. Means a separate T account for each class of asset. Similarly, provision account will be separate for each class of asset. There will be one provision account for machines, in which all of the machines will be listed. Then there will be one provision account for vehicles, and so on. So balance BD, as you are aware, provision is a contra asset. The balance BD always comes on credit side. If balance BD is on credit side, balance CD, closing balance, will come on the opposite side, that is debit. And if we chart depreciation this year, we'll be making an entry that income statement debit and provision account will be credit. Income statement will be debited because depreciation is an expense and the nature of the expense is always debit. Income statement debit, and provision, whenever provision will be increased, it will be credited because provision is a contra asset. Then if we are selling an asset, the total depreciation of the asset that is sold will be transferred to disposal account. Means if the asset, we do not no longer own the asset is transferred to disposal, and similarly if the asset is not with us, the provision will also be removed and transferred to disposal account. Then the shorter side will be balance carried down and it will become balance BD in later year. So these are two T accounts and one T account that we have already discussed previously when we were discussing revaluation method, and that was the value account, that is net book value account. One is cost account, one is accumulated depreciation account. These two accounts are used in straight line and reducing balance, and the value account is used basically in revaluation method. Then we need to discuss the disposal entries. Whenever we are selling a non-current asset, the asset need to be removed from our books, and there are basically 4 entries for non-current asset disposal. No matter which asset you dispose of, if there is a non-current asset that is disposed out, we will be making 4 entries in an exam. First entry is to write off the cost of an asset. This means we need to remove the original cost of the asset from our records. So if we are selling machine, vehicle, equipment or any other non-current asset, as you are aware, the nature of the asset is debited, and whenever the asset is removed or decreased, the asset will be credited. This is the original cost at which the asset, we have bought the asset originally. And if the machine account is credited, the opposite entry will comes on disposal account. Now what is disposal? Disposal is a temporary account that is used to record gain or loss on disposal. So what we need to remember here, that in all of these 4 entries, one side always comes at disposal. One side is always used as a disposal, and we do not need to remember the side at which disposal comes. Why? Because disposal can come on the debit side as well as credit side. Now how can we remember these entries? The easy way to remember is that machine or vehicle, these are all non-current asset, and whenever we decrease an asset will be credited, and if the asset account is credited, then the second or opposite entry is always disposal. Then if the asset is no longer with us, the total depreciation, we also need to keep the total depreciation or provision for depreciation for that particular asset. Now what we need to do is to remove the total provision for depreciation from our system or our accounting books. So if you are aware, the provision is a contra asset and the nature of a contra asset is credit, but if you want to remove or decrease the contra asset, we'll be debiting it. Accumulated depreciation or provision account will be debited to remove that provision from our records, and the disposal account again will be credited. So we do not need to remember the position of disposal account. If provision is debited, then obviously the opposite entry will be transferred to disposal. Thirdly, if we are selling an asset, we are actually getting some money out of it from disposal, that is scrap value. Whenever we are selling asset, we will be debiting cash or bank. Or if we have sold the asset on credit terms, mean we have sold it to someone and he or she has promised us to pay that amount in near future, will be debiting the debtor account Mr. X. So we'll be debiting Mr. X account and crediting again disposal. Do not need to remember disposal. If cash or bank or debtor is debited, disposal account will be credited. And last entry is gain or loss. If there is a loss is always debited. So the nature of the loss is debit. Why is loss debited? Because loss reduces our capital. The nature of capital is credited. Credit whenever we are reducing our capital, then the loss will be debited to income statement. If income statement is debit, then again disposal account will be credited. And if there is a gain, so income statement will be credited in case of gain. Why is gain credited? Because gain increases our capital, and the nature of capital is credit. Whenever capital increases, it is credited. Similarly, if there is a gain, income statement is credited, and if the income statement is credited, disposal account will be debited. So these are the entries for gain and loss, and the question arises, how do we need to calculate that gain and loss? So there is basically a simple formula to calculate gain and loss, and the formula is I haven't written the formula here. You need to focus on my words. First of all, we need the cost of the asset. Maybe we have bought an asset for $1,000 is the original cost of the asset, and then we have depreciated as the asset for maybe 4 years. Then out of that 1400 is depreciated, 400 is accumulated depreciation. Then if we deduct 400 from the original cost 1000, we get 600. The 600 is net book value of that non-current asset. And if we have sold the asset for more than 600, then comes the gain. If we have sold the asset for 650, then the $50 is the gain. And if we have sold the asset for less than book value, in our example 600 is net book value. If we have sold the asset for 500, the difference $100 is loss. So if we are selling the asset for more than its net book value, it's gain, and if we are selling it for less than book value, if it is loss. Then lastly, we need to discuss disposal account in calculation. If you have already made disposal entries, disposal account, making a disposal account is a piece of cake for you. There were 4 entries. The first entry, if you remember, you can go rewind and see the entries again. The first entry was disposal account disposal account debit and vehicle account credit. If the vehicle is credited, the disposal will be debited. Will be debiting the disposal with the original cost of the asset, and the reference would be machine, vehicle, and building. Similarly, if the asset is disposed of, we do not need the provision for it. So provision account is a contra asset. Provision will be debited and disposal account will be credited. Similarly, if we are selling the asset, we'll be actually getting the money. Or if we are selling on credit terms, we'll be using the name of the debtor. So bank or debtor will be debited and disposal account will be credited. If there is a loss, we'll be making entry income statement debit and disposal account will be credited. We'll be writing income statement, and writing gain and loss is also necessary in exam. And if there is a gain on selling non-current asset, disposing of non-current asset, income statement will be credited and the disposal account will be debited. Then lastly, in examination questions, sometimes the examiner asks to make you income statement and statement of financial position extract. Now let's see what are these. If you have already learned how to prepare an income statement, this is very easy. Depreciation is an expense for the business. So depreciation, all depreciations come in a category of heading of expenses. Similarly, whenever we sell non-current asset for less than book value, there is a loss on that non-current asset, and the loss always comes as an expense in income statement. Similarly, if we sell the asset at more than its net book value, there is a gain, and the gain comes in other income heading. So we'll be starting off with gross profit. Why? Because other income and expenses, both of them come under the heading of gross profit. We do not need to start the income statement here with sales and cost of sale. We just need to start with gross profit because we just need to show the expenses and other income. So all of the depreciation will be coming in expense category. If there is a loss, it will also be shown in an expense, and if there is a gain on non-current asset, it will be shown as an other income. We did not need to calculate profit for the year or net profit, because if we do not have gross profit, we will be writing X instead of it, and we'll be writing values here, and we do not need to calculate net profit because gross profit is also not available. Then similarly, we have balance sheet, statement of financial position extract. As you may be aware from your earlier studies, if you have made balance sheet previously, there are 3 columns in a statement of financial position. For non-current asset, these are cost, accumulated depreciation, net book value. Accumulated depreciation is also known as provision for depreciation. We'll be listing all these assets. It's better to list the assets according to the life of the asset. Means the building, we will be using building for most longer. So building has the longest life among all these. Then we'll be using equipment and these motor vehicles. So according to life, if we list all these assets, then it is appropriate. First of all, we'll be writing cost. Cost is the original cost, at which the asset was originally bought. Then accumulated depreciation. Accumulated depreciation is the total depreciation till date. Means if there is an asset whose accumulated depreciation is already 10,000 at the start of the year, and now in this year we are charging 2,000 further depreciation, then we'll be writing 12,000 in this accumulated depreciation column. And if the asset originally cost 30 and the accumulated is 12,000, we'll be writing 18,000 here, net book value. And after these two, we do not no longer need these two columns. We just need the net book value and add all these net book values. So these were the income statement and balance sheet extracts. So my dear students, I hope I was able to communicate you the underlying concepts regarding depreciation, and if you really benefited from this video, kindly do share this video with other accounting students. And you haven't yet subscribed my channel, kindly do it now. Thank you.